Hello, good afternoon, and welcome to the live trading hour brought to you by the Live Trade Room, where we'll be putting together our trade plan. We'll be looking at the fundamentals. There's a pretty significant ECB news event today, which we'll get into now in just a few minutes. We'll show you how we go about building our trade plan for the trading session, obviously with a view to sort of try and capitalize on some high probability trading opportunities. We'll show you how we select the markets that we focus on, what direction we're looking to trade them, why we're looking to trade them in that direction, and where we're looking to enter, and how we go about managing risk and everything in between. So without further ado then, let's just start the broadcast. So we'll put up our risk warning. Of course, take note of the risks involved in trading financial markets. I'm sure you all know, but if there is no opportunity for reward without risk. However, it should be an important part of your toolkit to address the risk side of trading these financial markets. Not be just focused on the profits and almost ignoring your exposure. That's the wrong way around. That's the wrong way to be approaching this environment. Certainly, if you want longevity, if you want to be trading for the duration of your lifetime, which is a viable pursuit. However, if you start getting involved in trading large percentages of your capital, it's probably a matter of time before you end up blowing up your account, and that's the experience from easily the majority of traders. So we're trying to instill a sort of a different skill set. Look for longevity, control your risk, be in the markets long enough to learn how to trade them. That's what most traders are missing. They want to get into trading, and within 3, 4, 5 months, they want to be, consistently profitable and making lots of cash and be able to leave their job and things like that. The reality of trading is unfortunately can often be a different experience for the majority of people. Not everybody, but the vast majority. So let's get on side. Let's get the markets working for us over time. And these are quite challenging market conditions at the moment for reasons I'll explain in just a second. We're going to raise a couple of very interesting points about these markets right now. But let's begin with a review of market moving news. So I alluded to the fact that we've got a very significant news event today. If we go down, if we look at Forex Factory, and today, of course, is Thursday, the 10th of June. So just down here, we've got monetary policy statement. We'll bring up the, I've got a squawk on as well. So if we get, I'm sure we'll get a market update on that shortly. So we'll see how the ECB over the course of the afternoon, how they have viewed how things are performing. I'm sure there'll be reference to the consistent rollout of the vaccine.
For this ECB decision, likely to stay on hold and avoid taper talk. No changes expected for interest rates, and new forecasts set to show higher inflation expectations. Just looking at a note from HSBC, they say with the recovery in the early phases, it could be too early to taper the pace of purchases, and they think the ECB will err on the side of caution. Consequently, they say they expect the ECB to maintain a higher pace of purchases for another quarter before starting to reduce it later in the year and wrap up the program next March as expected.
Okay, so that's really the forward guidance.
The updated ECB staff forecast, they expect a small upward revision to GDP growth and inflation in the medium term, which would still leave inflation well off the ECB's below but close to 2% aim.
So we should really see what the ECB's approach is towards interest rates and the potential increase in interest rates. The ECB are firmly lower for longer, so they may be one of the last federal central banks to perhaps start increasing interest rates, and they're certainly keeping their bond buying program in place until next year. Let's see if that changes. It's the deviation from the sentiment which is likely to be quite important for these markets. We'll have the refinancing rate very much expected to keep at zero, and for funds held in deposit, they're in negative territory. And then we'll have Christine Lagarde at 1:30. So often you might get a little bit of price action around the 12.45, and certainly pre-COVID, the big moves are likely to occur post 1:30.
1 minute.
Okay, so as we go into this event, we'll just monitor on the euro dollar. One thing to just point out, today we're seeing a lot of reversals across today's market, so that's just the nature of the market condition in which we're experiencing. But look at the ATR in some of the world's largest markets. This is the average true range. The range of these markets are diminishing significantly, all pointing to the downside. And this is the euro dollar, the S&P 500, the Aussie dollar, just to name but a few. And we're seeing that across the board. So we do have this reduced volatility environment. We're seeing much smaller ranges in these markets. That's a period we need to trade through.
10 seconds.
So let's go through the euro dollar, and we'll see how this market performs at this. We'll have a look at it on a 5 minute. Let's look at it in a minute. So we'll see the instant reaction.
Unchanged.
So we're seeing a bit of an uptick in the euro dollar. So nothing's changed. Everything is as per expectation. You can see us pulling back now off the highs.
So the ECB affirming its very accommodative monetary policy stance, says APP will run until shortly before interest rates rise, affirming the size of the pandemic purchase program at 1.85 trillion.
Okay, this is one of the reasons why we
ECB saying that the PEPP is to continue to be conducted at a significantly higher pace and during the first months of the year. Just to repeat that, the ECB saying net purchases under the PEPP over the coming quarter continue to be conducted at a significantly higher pace than during the first months of the year.
This is one of the reasons why we very rarely get into the initial news event, because you can get a bit of an explosive move and then you can get the swing lower. So it's a very temperamental.
To maturing PEPP bonds at least through the end of 2023, and the future roll-off of those bonds won't harm the policy stance.
So 2 minutes.
Headline there, just to repeat, the ECB and the PEPP to continue to run at a significantly higher pace.
So going into this event, there was very little price action. So we've seen a 10 pip move to the upside, followed by a strong reversal and ultimately a 10 pip move lower. We're still sort of within the 70s effectively. So and we can look at the daily time frame as well, and just from a trading perspective, we can see yesterday this market broke these highs and was moving to the upside. We kind of ran into a bit of a high, and we've seen a strong rejection of yesterday's move, and today we've continued lower, and it looks like we're kind of getting a strong rejection of the low. So we're in this market condition at the moment where we're getting a strong rejection of the highs and a strong rejection of the lows. So that's what makes this market quite difficult. Again, look at the ATR. We're down at sort of recent lows in terms of the range that we're experiencing in these markets. So currently the range in today's market, the average true range over the last 20 days is only 60 pips. So if you're a trader that's looking for a 100 pip return, you might be risking, let's just say for ease of maths, you take a trade, and because these markets are the way that they are, you're giving them a slightly larger stop loss than perhaps you'd normally do because of intraday volatility. So let's say you took a 50 pip stop loss. If you're looking for a 2 times your risk return, which is broadly speaking what we look to do, is to get a multiple of our risk every time we trade. And these markets are not great for that, because like you're getting an ATR range of 60 pips in a day, and you're getting a lot of up and down price action. So you're actually you're not making any material progress within that period of time. Now these things happen all the time in trading. We go through these consolidative periods on a regular basis. And what we're really interested in, as we often allude to, is the breakout of these levels to the upside and to the downside. Otherwise, you're kind of forced to operate potentially like a negative risk reward trade, where you're risking 50 pips and you might make 40, 30, 20 pips back, which is fine. There are traders out there that have a little bit more experience that can trade negative risk rewards. Certainly if you're starting out, it's certainly our opinion to adopt a positive risk reward approach. You can certainly look to fine tune that depending on the market conditions the more experience you get. So here's the initial reaction then from the ECB. If we look at it on a 1 minute time frame, so we've given it a few minutes now. There's your initial volatility. There's no change as far as the news event is concerned. So the ECB affirms the size of the pandemic purchase program at 185 trillion euros. So no significant policy change basically is kind of where we're at with this market, and as a result, no major sort of price move. Now the big event without a doubt is Christine Lagarde. She'll make her statement as she always does, and there'll be a series of questions from the press, and that can often create an awful lot of volatility in these markets. So we've got this price action. So what we'll do now is we'll go through our trade plan for the trading session. We'll see where the opportunities lie. We've also got important inflation data coming out of the US at 1:30 as well, not to be underestimated. And the Fed are doing a very impressive job in keeping bond yields lower. If I can perhaps, I appreciate I'm just jumping from thing to thing at the moment, but we had a 10-year bond auction yesterday in the US, and we were seeing these bond yields being sold at 1.5% over a 10-year period. So, obviously it's in the Treasury's nature to obviously raise as much capital as they possibly can for the smallest possible interest rate. And previously it was up at 1.75. So we had this situation in the first few months of the year, January, February, March, where it was the steepness of the move which was a bit of a problem for these markets. But the Fed have done a fantastic job reassuring markets and saying, right, well, there's no major concern here regarding inflation. We've all got our own opinions on inflation, like from like our perspective and from our family perspective as well. We're seeing nothing but prices increase, but the actual formal measurements of that data is not showing any significant increase. So the markets for now are absolutely going with the Fed on that. You would imagine beginning to come out of the pandemic, that we would be likely to see a very significant uptick in inflation, but we're told that that's not the case to any great extent. So let's see where we're at with the CPI data. Is it suppressed, or are we going to get, like last time we had a bit of a surprise to the upside? Will we see a similar surprise to the upside? We'll have to wait and see. But that's an important core CPI and CPI data, and that's just the basket of goods that you and I purchase every day, or should I say those in the US purchase every day. It's an index. It's a consumer price index, so it can show you if the price of those goods are going up or going down. So the Fed are basically saying that the price of goods is very manageable. It's transitory. We'll see prices settle down in the not too distant future. So what does that mean for our traders? It creates this sort of bland market condition, unfortunately. We're seeing significant demand for bonds, and we're seeing very little happen on the equity side. So if you look across these equities, we just got an awful lot of sideways moving price action, and sometimes that is just the market condition in which you're trading, like we find ourselves in now. So what a lot of traders will do, certainly a lot of more inexperienced traders, they'll throw their trading strategy out the window. They'll see all this really tight price action, and then they'll start saying, instead of swing trading, what we're going to do now is we're going to start scalping. We're going to start just trying to secure 5-10 pip return. We're certainly advocates of not doing that. Stick to your approach, but what you can do is you can make other decisions to try and control your exposure firstly, but give yourself an increased opportunity of success in terms of perhaps working with slightly larger stop losses. Still not increasing your trade size. So even if you're trading a 30 pip stop loss or a 50 pip stop loss, you can still trade the same amount of cash. You're just reducing your trade size down in line with your stop loss. And that's really what we teach traders to do every single day. You work out it's called your pip exposure, which is the difference between your entry and your exit. You work out what that is, and then you calculate trade size accordingly. And we have a trade size calculator which does all that for you. So that's quite a useful thing. And we just look across these markets and we can just see this price action. It never really fills us with huge joy when we trade markets that are just moving sideways. However, what is of massive interest to us is the next leg, either to the upside or to the downside. We don't mind which way it goes. If you will speak to us above, I mean, this is the knee case, it's probably not the best of examples, but above 29,200, we will certainly be, we'll have a bullish bias in this market. And below somewhere like the 28,700, our bias will be to the downside. So we're dictated in terms of what direction these markets move. We're interested in the commitment of others, not what we think. It's more what is price doing and what direction is it moving in, and then trying to prepare ourselves accordingly. Okay, so let's go through our trade plan then as we approach the US Open. We're seeing a little bit of a bounce off the Bitcoin market. We've got these, it's kind of a triple low. So let's see, do we get that explosive move to the upside, or is this just a little bit of a bounce?
The US,
lower?
The United States has dismissed EU trade and climate proposals ahead of the summit.
Okay, so we've got that summit there at the weekend with the G7. I'll just you got G7 meetings on Friday and Saturday, and there's a wealth of articles in there if you want to kind of read up on it. In fact, there's currently no articles, but I'm sure they will. They're discussing a number of different topics, from the coronavirus, giving certain percentage of their vaccines to countries that are in desperate need of more vaccinations, from tax. There's this new principle and policy proposed by the US that across all the, I suppose, the richer economies to adopt a minimum corporate tax rate of 15%. And other things like aid, and there's a few other issues as well to it as well. So it has the potential to be quite an interesting event. The markets will close Friday night, and we'll have more G7 meetings on the Saturday. Oh, okay, so it is actually going on all through the weekend. So actually, Sunday night's open and Monday's trading could be could be quite interesting with some decent opportunities. Just because there's likely to be a flow of stimulus hitting the markets, and they can price themselves accordingly, and that's what's likely to give us some opportunity. At the moment, the fundamentals, they're a bit bland. There's nothing really driving markets, which is why we're seeing these markets move sideways at the moment. So it might be a case of being patient, wait for the next stimulus to hit the market, for prices to discount and to correct accordingly, and that's what's likely to give us some high probability opportunities. At the moment, a lot of these markets are reversing. Another thing to just keep in mind is the 30-year bond auction. So the 10-year was very, very good for the Treasury. Now we're going to see the 30-year bond auction, see if they get the money that they're looking for. At what rate will they pay? and what will the demand be like for
Some
that
more
bond?
buyers now picking up on that. What I earlier reported. JP Morgan bringing forward their Bank of England rate hike forecast to Q4 of 2022. Prior forecast was Q1 2023.
Okay, so let's dispense with the. We'll come back to the fundamentals in just a moment. So just going back to the euro dollar, the reason why we look at this is it gives you an interesting indication in terms of how the markets are reacting to the ECB news event. And you'd have to say, or it's on the verge of being a little bit more bearish, but we're only really seeing we're currently 9 pips lower than, so we're getting this little breakthrough now. So this is technically a structural failure to the upside. So that's what breaking lower below this level represents. So we actually discussed last night in our trade plan webinar for dollar strength creeping into these markets. And that very well may be what we're going to get. What we want to really see now is on the daily time frame, these markets making a low, pulling back, getting the rejection, and then seeing that next leg to the downside. And that's what this price action could very well represent, is that next leg lower. So it is one to keep an eye out for. Now, we do have Christine Lagarde. This market could flip around and turn and become really quite bullish very quickly with Christine Lagarde. So it's not the best time to be getting into a trade, 20 minutes before a major ECB event. Just in our experience, it's not a great idea, irrespective of the price action. So that's the euro dollar. If we just put this up here, we can have a little snapshot. So we are looking, if I just get my, yeah, so we are looking for the euro dollar to the downside. Same kind of analysis really for the Aussie dollar. So we've had a bit of a turnaround in from yesterday's price action, which we would have liked the Nikkei lower, but it's actually kind of turned around. It's worth keeping an eye out for the S&P. The S&P to the downside would absolutely support our dollar strength trade. That's what we're sort of gearing up towards. So that means the euro dollar to the downside, the Aussie dollar to the downside. You can see they're not all cooperating just yet. And we can certainly look at the pound dollar to the downside below this level. It's really struggling to stay below that 140, 100 level, which is an important level for this market. So those are the markets we're anticipating further to the downside. The dollar yen, we're looking for a push to the upside, and the same situation for the euro yen. So the yen has been quite resilient. It's kind of been pulling back. It's been quite stubborn, and that's what we're looking to see happen. This is effectively our trade plan, and these are all on the daily time frame as well. So just a little small arrow on the S&P, because ultimately our bias for the US indices is to the upside unless we get unless we have reasons to change our mind, of course, which we'll be looking out for. Okay. So there's just a little bit of a question mark over the viability of the dollar strength trade. But this was our trade plan. This is what we were looking at yesterday. Some dollar strength. What we were interested to see this morning when we get to our trading desk is we have a trade plan that we're looking to implement. If markets move in the direction which we plan for, then we're able to pull the trigger. If they don't, then we're generally a little bit more patient. The problem with some of these markets this week and last week is we're getting up and down, so we're getting very little follow through direction. We'll get very little clarity across the correlations. There's a lack of sort of news that's likely to push markets in any particular direction. So we've just got quite bland market conditions at the moment. So really, patience is a big thing. We'll see if there's a little market update from the ECB now shortly. Like perhaps we can look at the Aussie dollar to actually roll over to the downside. And the S&P can squeeze lower. That's effectively our outlook. So let's look and see if there is a likelihood for a market like this to push lower. And there's your consolidation in this market. You know, that's the vast majority of the trading for over a month now, pretty much between the 77.80 and the 77.17 level. So you're only talking about a 60 pip range in this market, and that's very much what the ATR is telling us, 56 pips. We've just sort of rocketed to the downside. So just in case if you're wondering why we're not as active as what we would like to be, is because the market conditions are not giving us the green light. So you know, if you can be patient at these times, it does really help. One of the bigger ways in which your account where you can put things at risk is if you get a little bit too impatient and you're just looking to click the button all the time, and then you might get frustrated and start, you know, increasing your trade size and doing all the opposite things that perhaps you should be doing at this time. So if you can be patient, you know, and save your capital for when the market conditions clear up and we start getting some explosive moves, then we can be a little bit more aggressive. It's just that the trading conditions over the last month has been, you know, really quite challenging. And there's been a lot of situations like this with, you know, if we've got a very, very tight range, you know, we're getting false breakouts on a few occasions where you think, right, well, we're now breaking out of this this consolidation, and then it reverses back inside. So they're all potentially losing trades. Even that one, you know, they're all losing trades if you're looking to trade the breakout of this market. So this is where the confirmation, which is a close above or below with follow through, it can come into its own, because we've failed to get into any of these losing trades for one very specific reason. This is a potential sell trade. So what we want to see is the market close below. So we get the close below, we record the low, and then we want the follow through. So we want the next candle to come through, and unfortunately that failed. So, and then you see what it does is reverse back into this level. So of course the trade no longer exists for us. If it doesn't meet the criteria that we're looking to execute, then we can practice patience and just back off it a little bit. Okay, so that's the Aussie dollar. So do we have that turnaround bit of price action in the pipeline? It's just sideways moving, isn't it? So what we'd like to see is something like this, where the market attempts to make a new high, and then that fails. There's your structural failure. You just have to sort of give this a bit of time to kind of work itself out. And it might be like this across the board as well. So they're all effectively moving sideways with very little volatility. The euro dollar, which we do like to the downside. Let's look at it again on just the minute time frame. So there is a little bit of a bearish tone to this market, isn't there now? So will we get that next flush to the downside? There's your little mini trend to the downside. We had a good question yesterday. Why don't we trade the trend on the smaller time frames? It's a fantastic question, but the answer is quite straightforward, because when you trade the smaller time frames, like there's traders that trade what are they called? It's just gone from my head. Tick charts. That's the word I was looking for. They trade tick charts. So when contracts get filled with certain volumes, you'll see the candlestick print on the screen. This is by time frame, so we can look at 1 minute time frames, 5 minute, 15 minute. We adopt kind of a multi-time frame analysis, but the volatility and who you're competing against at these levels are a lot of your trading bots and your automated trading systems. And the problem is you're at a huge disadvantage. So they can execute trades at much better prices a lot quicker than you or I are able to do, because of the nature in which we use financial brokerages and we can execute these trades. So we're at a little bit of a disadvantage the smaller time frame you go. But probably more important is we're interested in the direction in which these markets move. So for example, it's quite a straightforward thing, but if the market is moving to the downside with some considerable volatility, we're looking for selling opportunities. And if the market is pushing to the upside with significant volatility, we're generally looking for buying opportunities, and we can keep it that simple and that straightforward. Traders can put an awful lot of additional complexity into these markets, and of course you need that little edge, that methodology that allows you to get in and out with discipline and being objective in your decision making. All of these things are absolutely true. Be consistent in what you're doing. They're all very, very important factors. But broadly speaking, we want to trade in the direction in which the markets are moving. And yes, you get false breakouts, you get turnarounds, but especially when you're starting out, it's by far more the over time, probably the most beneficial thing to do with you is to trade where the momentum is and the direction in which these momentum is moving. Now, markets like yesterday and today in the euro dollar can make a complete mockery of what I've just said, because there will be traders that will be benefiting from that reversal trade off the lows or off the highs. So these types of traders sell the highs and they buy the lows. Nothing wrong with that as an approach, and perhaps some of you perhaps adopt that type of approach. It's just really, really difficult. So what we do instead, and what we teach traders is to it's quite convoluted. There's a lot in it. Like, we've got a lot of education for our members. We've got over 50 hours of education actually in our members area, which go through a lot of this in a hell of a lot of detail. But we look at multi-asset class, so we look at different asset classes. We're not just focused on foreign exchange. We can get a lot of information from the global indice markets. We can get a lot of information from the commodity markets, and we almost put it together and develop trade ideas. At the moment, our trade idea is looking for dollar strength. We're not quite getting it just yet. Therein lies our ability to be patient right now. You can see a lot of these markets. You can see the phase that they're in. We're in a pretty tight range over the last month for the pound dollar. We're quite close to potentially breaking to the downside. So we've marked the 50. In fact, it's the 140-100 level for the pound dollar, and this is a high probability sell trade if prices can close and stay below that level. So far, they've not been able to do that. One of the reasons why we monitor multi-asset classes is so that we can see where the capital is going. We talk an awful lot about risk on, risk off. If it's risk on, you got capital moving into your riskier assets like your stock markets, and if it's risk off, you'll see markets like the S&P 500 sell off quite considerably, and you'll often see that capital flooding into your safe havens, like the yen or the gold or the US dollar or the Swiss franc, whatever the case may be, and seeing where that capital moves to is a very, very useful skill to develop. But you can see the nature of the volatility in these markets. It's just diminishing at a very significant rate, and often that just needs stimulus to to counteract it. So obviously, if we get some really strong headlines hitting the news, or some significant development occurs, then the markets will start to discount accordingly, and then we can start being a bit more aggressive. So really, none of our trade plan, none of the opportunities that we're looking for in today's markets look right now as if they're prepared to give us any opportunities to work with. That may change with the ECB. We shall soon find out. So what I'll do is I'll put back up our so this is what we're looking to see happen. We're looking to see the euro yen push lower, the Aussie dollar push lower as well, the pound dollar to push lower, and that would be quite supportive if the indice markets start to roll a little bit lower. We're likely to see the dollar to be the main beneficiary of that move, and then the others are a little bit more bullish. So we're looking for a continued turnaround in the euro yen, and same situation for the dollar yen. So we do anticipate the yen to continue to strengthen. It's been really quite resilient. We had the initial move, and we had the strong pullback, and now we're looking for that next leg to the upside. So that's the idea behind the trade. And that's really what we do. We develop trade ideas based on,
So we're now under 10 minutes until the bottom of the hour, and we get CPI for May. Year on year, non-seasonally adjusted, we're looking for 4.7% on the prior 4.2%, the range 4.2 to 4.9%. Month on month seasonally adjusted, we're looking for 0.4% on the prior 0.8%, the range 0.2 to 0.6. Core CPI year on year, we're looking for 3.4% on the prior 3%, the range 3.1 to 3.7%. With the month on month, we're looking for 0.4 on the prior 0.9, the range 0.2 to 0.6%. For the initial jobless claims, we're looking for 370,000 on the prior 385,000, the range 350 to 400,000. And for the continuing jobless claims, we're looking for 3.602 million on a prior 3.771 million, the range 3.55 to 3.771 million. For those interested, we have tweeted those that have contributed to the inflation forecast with their figures for the month on month and year on year for those that want to see. But looking at HSBC, they expect a 0.4% month on month rise in headline CPI in May, with motor fuel prices holding close to unchanged. They expect the year on year CPI inflation rate to rise to 4.7%, up from 4.2% in April.
Okay, so it's the monthly CPI, and then it's the impact that that monthly CPI will have on inflation as a whole in the US over the course of the 12 months. So we'll see what those figures come in at. We've got about 8 minutes left. I'll come back to that in just a second. And of course, on the unemployment claims as well will be interesting to see how the markets react to the unemployment situation. There's a nice sort of decrease in the unemployment claims. Where are we? This one here. So obviously things were pretty desperate there last year, and we're slowly improving. The last 2 months, the actual number of those people that claimed unemployment fell less than expected, which is obviously a good news. The next level is down at the 385 level, sorry, the 370. So let's see if it comes in and around that. That would be another good news story for the dollar, which again would support some of these opportunities. The euro dollar to the downside, the pound dollar to the downside, the Aussie dollar to the downside, and the dollar yen potentially to the upside, although it's got a little bit of work to do. And we're actually still in the euro yen. Just a little tip really, just regarding stop loss placement. We got in above this little break here, above the high, and we used the daily low as a stop loss. So the low is the 133.10. But what we do is we don't use the 133.10 as the price at which we want our stop loss. We actually have a 2 times the spread rule. So you work out what the spread is, and you times that by 2, and you add that to the bottom of the price. So that's normally about 3 or 4 pips. And what it does is it allows us to stay in trades like this.
Comments here from UK's Hancock, the Health Secretary, says that the current data is still not clear ahead of lockdown decision.
So we're probably less than a pip away from actually being taken out, but because we have our 2 times the spread rule, we can often get just prices just poked their head below or above these levels and reverse. You can see the same here to the upside. The high is the 133.34 and the 133.38. So you just get these little pokes above, and here's another one to the downside. The low is 133.61 and the 133.59. So on each of those occasions, prices just grazed below the low of these markets or the high of these markets. And if you build in a 2 times the spread rule, which is kind of what we have and what we speak to our traders about, then it can it just means you can stay in to a certain percentage of those trades which you might get stopped out on. You might be saving sort of 10 or 20% of those trades, but some of them can turn around and make you some good returns. So that's just a little tip on the risk management side of things. You might consider adopting it. It's remarkable how often prices just bounce off the high or the low. They do it on a regular basis. So look, as we go into this news event now in just a few minutes, we'll see what impact Christine Lagarde will have on the euro. Very little sort of move really. I mean, there's been no change as far as the ECB are concerned. So there's probably no real major need for prices to discount to any great extent. What I'll do is I'll delete a few of these. Okay, we'll see if we get a little market update now in just a second. We should do through our Squawk service.
So moving into 3 minutes now for this US CPI data. So due to base effects, the focus will be on the month-on-month price changes. So I will lead with the month-on-month in terms of ordering. So the CPI month-on-month seasonally adjusted for May, we're looking for 0.4%. The range 0.2 to 0.6. With the year-on-year, we're looking for 4.7%. Core CPI on the month, we're looking for 0.4. With the year-on-year, we're looking for 3.4%. For the initial jobless claims, we've got an estimate of 370,000. With the continuing jobless claims, we've got an estimate of 3.602 million. A reminder as well, we do have ECB President Lagarde. We do have the link on the board for her press conference. If she does start speaking, we will lead with the numbers first.
Okay, so pre-COVID, these ECB events were really quite often probably the most volatile events of the trading month. That and the Fed with their FOMC meetings, they are, central banks control the financial environment, and they do that through monetary policy like interest rate, bond buying, a whole variety of different measures that they can adopt to, I suppose, maintain a certain price stability. That's one of their remits. So they are by far the most influential part of the financial system, and very influential as a result. And the markets react, and they do listen very carefully to what these central banks have to say. So today we've got the ECB.
1 minute.
And we've got Christine Lagarde due to speak as well, so we'll get some data, and then we'll get Christine Lagarde. We'll probably get a live update through our Squawk service. In the description below, there is details about the Squawk service, so you can have a look into it, and there is a very significant discount if you happen to, if you want to sign up to it, and it's like an 80% discount on the fees. So only if you want to have a look at it, of course. You'll see the link in the description below. Please do subscribe to our channel as well if you can. Give us a thumbs up. We're here every day at 12:30, so completely free of charge, of course, through our YouTube channel. So
10 seconds.
Very welcome to join us. So can I zoom into the euro dollar a little bit more? I just want to see how this market reacts. Here you go.
0.6% for the month, with the year-on-year coming in at 5%. Core CPI in the month at 0.7, with the year-on-year at 3.8%. Initial jobless claims 376,000, with continuing at 3.499 million. So to recap that, CPI on the month 0.6 on an estimate of 0.4, year-on-year 5% on an estimate of 4.7, with the core CPI month-on-month 0.7 on an estimate of 0.4, year-on-year 3.8 on an estimate of 3.4%. Initial jobless claims 376,000, with continuing at 3.499 million, prior revised 3.757 from 3.771 million.
Okay, so the unemployment claims number came in a little bit above expectation. I didn't quite get the CPI and the core CPI numbers, so I'm sure we'll get those through momentarily. Yeah, CPI came in at 0.6, expecting 0.4. The unemployment number came in at 376, so 6,000 more people than expected claimed unemployment in the US.
ECB's Lagarde, now speaking, says the economy is gradually reopening, and says data signals a rebound in services and ongoing dynamism in the manufacturing sector. Says it expects the economic activity to accelerate in the second half.
So here we go. We're beginning to get some initial momentum. So we're going to get our trading platform open and ready to go. There's a little bit of volatility. It's kind of swinging high and low. I mean, even the dollar yen has kind of now looked a little bit positive. You know, we're geared up for some dollar strength, by the way, just so that you that's what we're gearing up for, is the dollar strength trade.
Headline inflation likely to increase in the coming months. Inflation pick up, though, largely on account of base effects. Says inflation is then to decline as temporary effects fade out, and projections point to inflation pressures rising.
So the ECB are saying it's transitory as well, that the prices...
And underlying price pressures subdued due to slack
in the jobs market. You know, the more people that go back to work, the more money they'll have in their pocket, the more they'll go out and spend.
And Lagarde repeating that headline inflation will be below aim over the horizon.
There is a bit of dollar strength, but it's not that meaningful just yet, or certainly doesn't appear to be. I'm looking at some charts as well off screen.
And Lagarde here saying that rates could tighten financing conditions.
Even the gold market is beginning to tick higher a little bit. Just having a look at the S&P.
ECB statement saying premature tightening poses risk to growth and inflation.
So let's see if these figures have come in yet. Okay, so an uptick on the inflation story, above expectations. So how do we interpret that? If inflation pushes higher, then what we can, that's likely to push the stock markets under a little bit more pressure. We're likely to see a slight uptick in the bond yield, which is basically what we're seeing. We were at 1.49 just 10 minutes ago. So now we're at 1.51. So a very gentle and very slight uptick. Oh, sorry, where's it gone? Let me get it back for you. So we were down here at 1.47. We've it's kind of flatlining, isn't it? But what this is likely to do, the actual rate is 1.51. So we're actually now up at these new highs just up here. I don't know why this graph isn't showing it, but the rate is 1.511. So we are seeing the uptick. That's not necessarily great news for the indices markets. You see, we're coming off a significant level at around 1.75, and we're still around the 150 mark. So broadly speaking, there's no major concern. It is a slight uptick. The CPI, again, there's a further revision to the upside. So it's estimated around 4.7% CPI figure. I don't know if this is core or if this is just the CPI figure. So we're now around sort of the 5% mark. So 5% growth in the index, from what we understand from the Fed and ECB, is kind of manageable. It's well within the realms of what they would expect. It's transitory. It'll settle down. All this sort of thing. So let's wait and see, I guess. If the Fed or the ECB get this inflation story wrong, you can expect a major correction in these markets. You can expect bond yields to be kicking up to the upside, and you can expect stock markets taking a very significant move to the downside.
US Fed fund futures in thin volume, fully pricing rate hike between April to May 2023.
So we got a flush lower, probably off the back of the inflation. It's like, okay, it's ticking higher. That's not good. It'll sell off. And now we've had the pullback. But we're still broadly in consolidation as things stand, although there's a little bearish bias to it, as you can see. I do apologize, guys. We need to shoot off. We've got another trading session now. So our trade plan still stacks up, although the opportunities are not revealing themselves just yet. So we'd need to see kind of structural failures to the downside for the euro dollar, the pound dollar to the downside, the Aussie dollar. And it looks like we're just getting actually reversal signals again. So look, it may very well be the case that today might be a very poor quality trading day. If that's the case, we can be patient. We can plan again tonight.
And the ECB will monitor the FX rate on the inflation outlook.
So the ECB,
that the ECB is ready to adjust all instruments as needed.
So they're prepared to do whatever they're prepared to do. The ECB found the 120 level to be a bit of a concern for the euro, and as you can see, we're up at 121.75, so we're easily above that. You know, I'm sure they would prefer that euro dollar to be below the 120, but it doesn't look like they're actively pursuing it to any great extent. We might get sort of a natural decline. So the Aussie is filling up to the upside. We're getting quite a strong, let's say it looks like that dollar weakness trade is stacking up yet again, and we're seeing the indices markets actually turn positive. Sometimes it's a case of, if in doubt, look to stay out. We're getting quite a positive reaction in the indices markets with increased inflation. That's a little bit counterintuitive, if you don't mind me saying so. There's grounds for the dollar to strengthen and the indices to weaken, and we're seeing the opposite. These markets have this ability to do this recently. Maybe that yen weakness trade might be a marginally better opportunity. Getting a strong rejection to the downside now in the euro yen. We anticipate this pushing up to 134 plus. So hopefully we'll still get a decent move in this market to the upside. But we just got quite a mixed little picture now. We were hoping that the ECB would provide a little bit of clarity, and we've probably got less clarity now than what we had perhaps 20 minutes ago. So these are the directions, and just regarding having a trade plan, if you do create a trade plan and you've done your analysis and there's things that you're looking for, do try to stick to that analysis. As opposed to just chopping and changing. So, for example,
2021 GDP growth of 4.6% versus 4% seen in March 2022, upgraded as well to 4.7 versus 4.1 in the March 4. I'll just
turn it off. So this is our trade plan. Euro dollar to the downside. You can see it's pushing higher, so it's not a goer. There's a potential opportunity in the dollar yen to the upside. You can see that the Aussie dollar, we were looking for it to go lower. So what you won't see from us generally, occasionally you might, but we won't go against our trade plan. So if we create a trade plan, we're looking for the S&P lower, and we're seeing that reverse, and we're seeing the pound dollar reverse. So what that leaves us with, of course, is potentially looking for viable trading opportunities, but in the euro yen to the upside, which we're already in, and potentially a bit of a question mark over this one. But this is our trade plan, and this is what's going to get our attention. The euro yen first, and then perhaps the dollar yen. And this is how we kind of manipulate our trade plan, so to speak, is that we have a series of different opportunities, and some will obviously kick off sometimes at various different times, so we can be prepared accordingly. And if they're reversing, all of these are reversing in the wrong direction. We're looking for these prices to push lower, and they're all pushing to the upside. So just a couple of little perhaps tips there, perhaps to take away, and if you can utilize them, then good on you. So yeah, we've got probably the euro yen is probably given us the best opportunity across these markets. Even this one is a very mild structural failure to the downside. Let's zoom out. So actually here is your structural failure trade to the upside, where the market fails to, in fact, it's a really strong rejection actually at the low. And then if you break the 133.59, then there's your high probability trade, and that would be supportive of our previous trade, which is the entry to the upside. Don't know when we got back into it. I must have been in this zone here, I think it was actually. So let's see how you get on with it. There is a high probability trade above 133.59. If for those of you, if you just want to monitor it, feel free to do so. And we'll keep an eye, of course, on the euro dollar. We'll see if it edges lower. Same with the Aussie dollar. Same with the pound dollar. We'll keep an eye on the S&P. Not that we're looking to trade this price action. We're just looking to see if if there's capital moving in or out of the indices markets, and the dollar yen might be an opportunity to push to the upside. So it looks like we're close to getting an opportunity to the upside for the euro yen. So look, we're going to have to leave it there, I'm afraid, guys. Thank you very much for joining us. Give us a thumbs up if you can. Subscribe to our channel, and we will. I'll leave this currently up on screen, and we're going to be back tomorrow at 12:30. If you do like our style or our approach, and you'd like to spend a bit more time trading markets with us, we do a live trade plan. We have webinars every evening so that we're prepared for the following day's trading. There's the link below, so and you can contact us through our website as well if you need any more information. And you can do it for as little as $15 a month as well. So price point for us is very, very low. However, there's a really good sort of day-to-day sort of mentorship and education, and there's a fantastic offering there. So listen, on that note, thank you very much for joining us. We'll be back again tomorrow at 12:30 from everyone here. Bye for now.